so whilst this doesn't have a direct impact in relation to open banking per se, it has a massive impact on the underlying plumbing and infrastructure which the world's financial services run on. And I just think it'd be useful to you to know what's going on. A pilot that's going to start in 4 months' time, involving around 44 of the world's regulators and about 400 odd commercial banks to actually try to do something called atomic settlement. The internet created a global market, but the world does not have a single currency. And I wrote those words on the business plan for WorldPay in 1997. And ironically, that's still the case today. And if you look at the way that diversions have moved in relation to cryptocurrency and all the rest of it, the reasons for that are that interoperability of fiat currencies, the currencies that everybody in this room use, hasn't moved forward. They have tended to remain as domestic products. And whilst our company is called RTGS, everybody thinks, including Mark Carney, that it stands for real-time gross settlement. It actually stands for real-time global settlement. So it's somewhat different. So what is the issue that we're trying to solve, and why have we set this business up, and why are we throwing a hell of a lot of money at trying to prove something that nobody's done before? There is a fundamental flaw in the way that the financial service industry has been constructed, and that is that interbank liquidity is invisible. What I mean by that is Barclays know how much money they've got, we at Clearbank know how much money we've got, but we have to trust each other that we actually have that money. There's no independent verification, and even the regulators don't know this. They don't know what the position is. And when you start applying that and look into how all of that works in relation to international payments and payments flows and all the rest of it, it starts to create a very significant problem. Okay. Interesting fact, and that is that no bank in the world gives any of its customers a service level agreement for anything that it does, especially in relation to international payments, because they can't, because they're all reliant upon everybody's infrastructure. So what we started to do last year was look at how we could actually make liquidity visible. And we couldn't have done this till last year because the technology and the networks and the capability to actually run a real-time global settlement system in real time. And I'm talking about doing transactions between New York and Sydney in 300 milliseconds, completed with the funds ownership being switched. You couldn't do that last year. You can't do that on the blockchain. You can't do 36,000 transactions a second at that rate. It's just that technology wasn't available. So what we've been doing is working with Microsoft and others to build a global platform to actually develop a system which allowed us to see interbank liquidity. So we started last year, going out, having come up with this stupid idea, filing patents in 153 countries, which was an interesting job. And then I spent the best part of 4 months flying around the planet, meeting regulators and central banks and commercial banks to talk about what we were trying to do, to make sure that they were happy with what we were trying to test. And from the World Bank, IMF down, we've got support behind the first part of the project we're running out this year, which is a pilot which starts in June. What we realised we needed to do was change the dynamics of the way that transactions flow into bank. And if any of you are involved in the card industry, what I'm going to talk to you about now, you're going to say, bloody hell, he worked that out when he was at WorldPay. Right? When a bank in America, for example, wants to make a payment on behalf of its customer to a UK customer, it has to buy sterling. It doesn't have sterling, it's got US dollars in its bank account. So it enters into a relationship with the UK bank to buy sterling to effect that transaction. And at that moment in time, the banks run on trust that each of the banks will pay each other. And that friction that occurs in that process is huge. One of the things we did last year was looked at the world's economic friction cost. And this is the cost to the global economy of all the things that don't work. So I don't have to do a list of these because you all know what doesn't work. All right? And so we did a calculation. We came up with a number of $2.7 trillion a year, which is about $87,000 a second of frictional cost. And so we sat down in December in Washington, DC with the World Bank and the IMF, having a very, very big meeting about this. And the guy from the IMF said, your number's wrong. And I thought, thank God I haven't told many people this number. And they said, no, it's the wrong way. And I said, we've only got small calculators in the UK. They don't go much bigger than 2.7 trillion. And he said, no, the number is $15 trillion a year. That's what they estimate the financial friction costs. If you divide that by every consumer and every business on the planet, it's a horrifying number. And if you could reduce that friction cost, either my number of 2.7 trillion or their number of 15 trillion, by 50%, that's the single largest cash injection that the world's financial service industry can give to the global economy in relation to improved cash flow and all the rest of it. So what we've done is develop technology that allows us to apply a liquidity lock within the bank that's sending the money or buying the money, and a liquidity lock within the bank that's going to send the money on. All that is doing is validating and confirming that they have the money. Now, strange as it sounds, when I checked into the hotel over the road a little while ago, they did exactly the same thing with my credit card. Because they think I'm a great guy, I stay there virtually every week, but they want to know that I've got sufficient liquidity to pay their bill before they give me the key. And that's what we're doing. We're making sure that they have got sufficient liquidity before they're given the key. When the customer accepts the transaction, or whatever charges are set and defined by the banks, the forex, FX rates and whatever are set by the banks, we're not involved in that process. We're just acting, I think, a bit like an auditor. We produce a liquidity block, and that liquidity block releases instantaneously and concurrently the two liquidity locks and flips the ownership of those funds. So the funds in the US bank go for the benefit of the UK bank, and the funds in the UK bank go to the benefit of the American bank. What we do is then provide back-end access to all of that to the regulators. Because surprisingly, the regulators, I don't know where the governors are from Brazil or whatever, but they'll be going a little bit red at the moment, because the banks, auditors and regulators, they can't see this stuff either. And if you want to find out how much that hurts them, go and talk to Westpac in Australia about the fine that's heading in their direction, which is huge. And so there's no reason why the banks would not share real-time liquidity visibility with their regulators in relation to what historically sat within their Nostro-Vostro account structure. And I bet there's multiple benefits of actually providing that information via our network back to the regulators in relation to information on monetary control, but also information in relation to potential significant capital savings for the banks that use this service. You were the first people outside the internal team at RTGS to have seen this stuff. So in June, screens very, very similar to this were being shared out to commercial banks around the world, and then once we've done 8 weeks of testing with them, onto the regulators who are involved with this project to actually see how atomic settlement works in real time. The reason why we're taking the time to do that is that today money follows the sun. Tomorrow, in an atomic environment, it doesn't need to. And so we have an interesting challenge where Australian businesses can actually make payments to companies in North America a day before they're due. Now, interestingly, the Federal Reserve Bank have already ruled for us on how that issue is going to be dealt with. And I think that demonstrates some of the commitment we're getting globally in relation to trying to make this project work. By 2021, on the assumption this works, and it might not, right? Because we have operational issues, and we've got to get down to Madge in the operations team at the bank understanding the implications of this. Into 2021, we move into a live pilot and then a progressive rollout. If all of this works, it will have a profound impact on all of the customers of open banking in relation to all of their international payments. And in certain countries, this is potentially going to replace the domestic payments infrastructure.